budget is definitely a hot topic at the moment, capital gains tax and negative gearing.
So what about the property I already own? Am I still affected? We need to get a valuation done.
Super fund property investments, inflationary indexation rules.
Today we have Mel joining us from ProGrid Finance, she's a mortgage broker, been for quite some time.
Yeah, 11 years.
There you go, over a decade. I thought today we'll talk what has been on everyone's minds and obviously on the topic of the dinner table as well, the federal budget. We feel when it was released, it wasn't too much clear what we're hearing from our investors, and as part of our service and commitment to them, we thought we'd sit down with you in terms of the first person that'll be able to talk about it in detail and go through everything.
Sure, thanks for having me. The budget is definitely a hot topic at the moment, and it was quite confusing, especially around the property changes, just because of the amount of dates and treatments of different properties, and so there was a lot to unpack, and probably there still is a lot of confusion around particularly investors. It's kind of the biggest tax reform regarding property in the last 25 years, so it's pretty major. And actually a lot of people watched it, which was surprising because generally the budget comes and goes and nobody actually even knows that it was on. So it had a lot of focus this year. So yeah, it's a really important thing. Obviously the biggest changes were two kind of key pillars for investors, which are CGT or capital gains tax and negative gearing, which both will impact investors moving forward.
What is negative gearing for the viewers and how does it impact the property investors in particular? Yeah,
so in simple terms, negative gearing is essentially like holding costs or the costs of having an investment property exceeding the profits that property will make or the income or return that it makes. So essentially, if you had a property that earned you, let's just say $30,000 for a year, and it cost you $50,000 to hold, you would essentially have a $20,000 loss is kind of how it's thought about, and that can actually offset any other income that you earn in that taxable year. So basically, if you have a $120,000 salary, then you can offset that $20,000 loss that you had on the investment property. You can actually put it against your salary and you'll only be taxed on $100,000. So you can see that it's actually a really useful and effective tool for investors. And it did kind of justify holding a property even when it was making a loss in some cases for investors. So that's now not going to be the case moving forward.
So Mel, what is actually changing from the 1st of July 2027?
Yeah, so basically what they've announced is there will be no negative gearing on anything except for new properties now. So moving forward, if you had an existing property that you owned before 12th of May, 7:30 p.m, which was the budget announcement, you will still continue to receive negative gearing benefits, but anything that is acquired after that date that is not a new property, classified as a new property, will not receive any negative gearing benefits. We've got a transition period for about a year, so up until the 1st of July 2027. So everybody will get negative gearing benefits up until 1st of July 2027. If you've bought a property after budget night though, come 1 July 2027, you will no longer be able to claim a negative gearing benefit on that property unless it is a new property. So it's definitely changed for any existing property holders that are buying property between budget night and 1st of July 2027. For people that owned property prior to that, it's fully grandfathered. So if you had an investment property before 12th of May, 7:30 p.m, or you exchanged contracts, so even if you bought something and it hasn't settled yet, you will receive the negative gearing benefit moving forward until the property is sold. Key message for existing investors is we can breathe. There is no changes for you. You're completely unaffected by these negative gearing changes.
So what about investors that are looking to purchase now?
Yeah, so basically anyone that's going to buy a property now after budget night, there is a transition period between now and the 1st of July 2027, so you'll still receive a negative gearing benefit for a year. So we're basically getting a grace period. So if you exchange and you're settling on a property now after 12th of May, you'll get negative gearing for the next financial year. After that, you will not receive a negative gearing benefit unless you're buying a new established property. So there's definitely still a window for the right type of properties and for the right investors to actually get into the market through this transition period up until 1st of July 2027.
So the federal government are pushing for investors to purchase new builds. What is the intent behind that?
Yeah, so basically, because they're offering negative gearing to new builds, so it's going to work exactly as it works previous to the budget announcement for anyone buying a new build, they're hoping that people are going to be adding to the supply of property in Australia and making it easier for first-home buyers and people that want to enter the market.
Okay, so if I've got an existing property and I knock down and rebuild and build a new home, does that apply?
No, so there's a kind of clear definition of what a new build is. So it's actually anything that adds new supply to housing. So if you're going to knock down an existing property, one house, and build one house in its place, it's not adding to the supply. So it has to be adding supply. So you could knock that same house down and build a duplex, for example, because you've built two dwellings, that's going to then add to the housing supply, and that will qualify then for the negative gearing benefit. So things obviously like off-the-plan apartments, any kind of greenfield project where you're buying land and building something on, all of that will have that negative gearing benefit.
Okay, so it's more so funding and building the supply of Australian property. Capital gains tax, CGT. A lot of people heard about the 50% discount disappearing and put the fear of God in them and panicked. What does it actually replace?
Yeah, so there's two major changes to CGT, capital gains tax. So the first one is everybody knows about the 50% discount that they were getting on capital gains. It's moved to a cost-based indexation. So basically what this means is your purchase price is going to be adjusted for inflation, and you'll only pay the tax on the real gain, not the inflationary gain. So essentially, if you think about you've bought a property for $1 million today, in 10 years' time, obviously that $1 million is not going to be the same because of inflation. Everything appreciates over time. So they're going to add indexed inflation year on year to the asset value. And when you sell the property, you will pay a gain on the difference between the inflated value and the real gain that you've made. That's what you'll pay tax on. And the second major change is that it's going to be taxed at a minimum 30% for capital gains. So this is a big one because a lot of people used to use the CGT 50% discount rule in years where they might have had lower income. So for example, if they'd taken a year off work, or they might have retired and therefore their tax bracket, they were in a low tax bracket for that financial year and therefore the capital gains tax was less. But the government has now imposed a 30% minimum tax on this. So that's obviously a pretty significant change as well.
Right, okay. Is this better or worse for investors?
Yeah, so this is really going to depend on the asset growth versus the inflation rate. So if your asset is growing at a much higher rate than inflation, then it's not going to be great for CGT calculations. So basically the government did their own modelling and they've found that over a 20-year period on a typical asset, you would get effectively an indexed discount of 35 to 60%. So it might not be catastrophic. It's for mainly the Sydney investors who have seen, triple growth or double growth in their asset in a short period of time. Moving forward, that will definitely impact investors, but I don't think we're in an environment at this stage, definitely not for the next few years, where we're going to be having, growth outstrip inflation by too much. So
Perfect. Well, that's good to hear. But the existing gains, are they still protected under the current rules?
Yeah, so the government is not taxing people retrospectively. So basically, if you've held an existing investment property, let's just say you've had something for 20 years, you will get the CGT 50% discount up until the 1st of July 2027. So any gain made up until 1st of July 27 is under the old rules. And then on the 1st of July 27, that will change to the indexed inflation rule, and that then will have a portion of the gain will be taxed at a new set of rules versus the old gains. So there are going to be two treatments for the same property, essentially. I heard an accountant say the other day the reason they scrapped this is because it is so confusing and so technical. There's going to be tools on the ATO portal which will be able to calculate the CGT on 1st of July 27 moving forward, because there's going to be an inflation rate each year that the capital gains tax will be calculated on. So it is quite complex.
I've heard also, I believe from you discussed in our office recently, some banks have already removed certain tools from their index.
Yeah, so for borrowing capacity, this is going to be huge for investors because negative gearing is the main thing that we had in our calculations for investors, where that was actually adding capacity to their calculation. Whereas now the banks have changed, they've pulled right back and they've said we're going to match the government's policy now. So we're going to remove negative gearing out of those calculators. So capacity will be less moving forward.
Right, okay. Also the topic of valuations. We need to get a valuation done before July 27 or after?
Yeah, so as I said, there'll be up until 1st of July 2027, whatever capital growth you've had on an existing asset will fall under the 50% CGT discount rule. Right. So investors will need to get a certified valuer to do a valuation on or around the same time of 1st of July 27, so that when their indexed inflation capital gains tax calculation is being assessed, it's being assessed from that cost base as of 1 July 2027.
Okay. Can that also come from an appraisal or a licensed valuer?
It can't be an appraisal, it has to be a certified valuer, or I believe there will be a tool on the ATO portal which will be able to give you a value as well. I imagine most people will get a certified valuer to do their valuation.
Okay. Also a big topic, how will it impact the rental market, and to say also where do we see it going?
Yeah, so obviously the whole idea of this is to reduce investor demand for established properties, which means that the pool of people that are trying to buy these properties is obviously going to reduce, which means that there may be some softening in prices temporarily in those types of assets, but on the flip side of that, there's also going to be less investors acquiring established properties, which means there's going to be less supply of investment properties available for rent, and that will drive rental income up. So I guess as an existing investor, with the CGT kind of grandfathered up until 1st of July 2027, the negative gearing grandfathered until properties sold, and then potentially an uplift in rental incomes, this may not be such a bad time to be holding those investments. And in some cases, you might have an investment property that was negatively geared before, but now with any rental increase, it might actually be neutrally or positively geared anyway. So yeah, it could be a really good time for investors to hold on, I think.
I think so. So obviously for them not to panic, don't sell because you miss out on all the negative gearing because it disappears once it sells. So hold your investment for the longest period you can because that's probably where all the benefits are still are.
I think that also a really important thing to note as well is that these changes are applying to multiple asset classes. It's not just property. So if you're thinking about liquidating your investment property to then go and reinvest in something else, you're losing your grandfathered benefits on this one, and then you're actually going to be taxed at the new rules for the new asset. So it could be, shares or businesses or whatever it might be. So I guess, that recycling of investment income or profits that you might have in a property might not make so much sense.
It won't be beneficial for them.
Probably not, yeah.
Taking all of that in, does that change the type of investor that you want to be?
Yeah, definitely. I think there's going to be a real shift towards, typically we were kind of tax motivated investors. Now I think we're going to be more yield motivating investors. So people that are actually generating income from their asset rather than trying to claim this negative gearing tax benefit. And historically, the negative gearing did kind of make sense for people that were holding assets that might have kind of had a loss associated with it. But moving forward, it's not going to make as much sense. So if you've got an income generating property and you are going to obviously pay tax when you earn income, but that is now most likely going to be a more attractive investment than something that's actually losing just for a tax benefit.
Taking what we've discussed, what opportunities do investors have today that has further opportunities for them in the future?
Yeah, so there's a couple of different areas now in residential property that might have a bit more of a focus. Things like super fund property investment. So inside your super fund, it's extremely neutral, kind of low tax environment. So things like there's no changes for capital gains tax inside SMSFs. And capital gains on a property that you've sold inside your super fund is actually taxed at a flat rate of 10%, which is obviously extremely low. And then if you're retired, it's actually 0%. Any income generated from that property inside a super fund is also taxed at a lower tax rate. It's a 15% flat rate for income inside SMSFs. So that could be a very attractive entity to be investing inside of. The other thing is company entities. So they actually never got negative gearing in the true sense anyway, because a company works on a profit and loss basis. So basically, if you're earning an income from the property, that's your profit, and whatever it costs you to hold is your loss. So if you invest in property inside a company and it's losing $20,000 a year, well, there's obviously no tax payable on that profit because there is none. So that also may be a good kind of opportunity potentially for the right investor. But there's also things to consider around transferring properties between individual names and into any other entity will incur potentially capital gains tax and also stamp duty as the new entity is actually purchasing that property.
So it's more of a changing of strategy rather than fearing the worst.
Yeah, absolutely. I think, as we said, existing investment property holders prior to budget night, I mean, you're fully grandfathered for negative gearing. Capital gains tax is going to be adjusted from 1st of July for any gain made after that under the new inflationary indexation rules. And so, rents potentially are going to increase because of this. So I think there's lots of incentive for investors to stay in the market. I think that you need to kind of pause, make sure you fully understand what the implications are, because in most cases they're probably going to be very marginal. Talk to your accountant and all the professionals that are qualified to give the advice.
Talk to you.
Talk to me.
And only you.
And it's definitely not all bad.
Now, if you had to give the listeners one thing to do this week, what would it be?
We want to make sure we're understanding the numbers and what the competitive advantage is now for people that already own property, because there is going to be a dramatic shift moving forward from 1st of July 2027. So go and speak to your accountant, go and speak to your broker. You've got about a year to kind of, before all these changes are coming into play anyway. So let's take a breather and have a look at what this really means. Don't make any irrational decisions, because you do have kind of this grace period anyway. And it's not all bad. Like I said before, there's plenty of opportunities. There are opportunities in other residential property investments. If you're really keen to invest, there still is obviously that new property that you can invest in with all the current rules prior to the budget. So I'd say just take a breather and review rather than react.
Done. Well, it's not the end of the world yet. So it's a good point. Relax, refocus on the strategy, revise the strategy. And I think, in my opinion, that's why picking the right mortgage broker as well as an accountant and even your real estate agency as well, in terms of how it's all managed as an investment, is more important more than ever. I think having the wrong person will evidently have a domino effect, and you do have a grace period, but at the same time, by the time you know it, we're at July 2027.
I think, the key is obviously the best time to plan your moves is now, while everyone else is trying to figure out what to do next.
That's our take on the federal budget. If you do need a trusted mortgage broker to guide you through everything and to make sure that you have the right strategy in place, Mel is the right person to speak to from Pro Good Finance. We'll plug all of her socials there so you'll be able to reach out to her and talk strategy. Mel, thank you for being a part of the podcast.
Thanks so much for having me.
Okay, shake it up.
All right.
And that's our take on the federal budget.
It's not as simple as you thought it was going to be.
No.
Welcome to the party.
Shake it out.
Shake it up. Shake it up. Can I say Pro Good Finance? You can crop it.
Yeah, all right.
Okay. From Good Pro Finance.